We have a quick question from Ashan who says, we recently in a video spoke about timing entries correctly, and just want some more information on what exactly we mean by that. So thanks for the question, Ashan. When it comes to timing the market, it is one of the more subjective and tricky parts of trading, and is a little bit of an art and something that I find challenging to this day. There is a popular comment out there that says timing the market isn't as important as time in the market, meaning that even if you manage to buy all the lows and sell all the highs in equities, for example, your overall return wouldn't be all that much different from somebody who just simply bought and hold equities over a very long time period, holding it through both tops and bottoms, so to speak. Now, when it comes to our type of trading, which is a little bit more short to medium term, because we try to find value where we can, there is a lot of potential for larger profits and higher growth if we can time the market correctly by exploiting things that are either undervalued or overvalued. The one challenge, though, is that timing the market is difficult, especially if you're a day trader or even a swing trader. It's slightly less complicated when you swing trade because there's a little bit more time out of the UK, 2000, because you have a little bit more time to react, but still a challenging task nonetheless. And the reason why it's so difficult comes down to volatility in the market. Now, sometimes you might be right on the overall direction of a currency pair or a commodity or an equity, whatever it might be, but you might get into your trade too soon. And due to potential volatility from unexpected events or short term catalysts, you might get taken out of a perfectly good trade just to see it find its way moving in the wrong direction, or right direction rather, that you traded it in just a couple of days or sessions or weeks later. Now, even though we try to find good spots for our stop losses, there will always be short-term events that we cannot foresee that can create enough volatility that takes us out of our trades prematurely. That is why we always try to give our trades enough room to breathe, like we mentioned in that prior video, to try and offset some of that potential volatility and that potential pullbacks or corrections against our trades. But there will be times when either our analysis is wrong, or our stop loss placement is wrong, or our timing is wrong. A good example is the Aussie Kiwi. Now, this is a trade that I've been long for quite a while now. I've got a couple of entries in my personal account between that 110 and that 109. Now, when I entered, I couldn't have known that Governor Orr would come out pushing back against the exchange rate comments, and we couldn't have known that Australian GDP would come in worse than expected. And in the short term, those catalysts has pushed against our trade. We also had the equity sell-off, obviously exacerbated some downside in the Aussie, weighing more on the Aussie compared to the Kiwi. And those factors might be enough to eventually take me out of this trade. My stop is sitting right here at that 107,950, or just below that 108 level. And these short-term factors might be enough to take me out of this trade. So looking at this trade as an example, we can lose this trade for three different reasons. Firstly, we might lose it because, or me at least, I'm in this trade. I might lose it because my analysis and reasons for entering wasn't correct, and I don't think this is the case for this specific trade. I do still think the bias in the medium to longer term is to the upside. Secondly, I might lose this trade because my stop loss isn't in the right spot. Maybe I had a too tight area to consider for the trade. That's always possible, and that we might not, give our trades enough room to breathe. Again, with regards to this trade, I don't think that's the case because there's a specific structure that I was looking at from a support point of view that I didn't want to see fold for the trade. And then thirdly, we might lose the trade just because the timing isn't right. Um, maybe the Aussie Kiwi trades higher in the next 2 or 3 months from now. We don't know. But in the meantime, our timing might be completely wrong, and the move might go against us, taking us out of this particular trade for those short-term factors that we couldn't have planned for. So we always need to consider which one of those three is the reason for us losing a trade. But we will never be able to avoid losses, right? They are part of the game and a necessity to make profit. But because losses is a guarantee in this business, that's also why we always need to follow sound risk management in our trades, not risking more than we should. and also, just keeping our psychology in check so that we don't end up revenge trading and losing 2 or 5 or 3 or 10 times what we originally would have lost if we just kept our cool. So that's basically what we mean by timing the market, Ashan. So there's going to be times when you might be wrong on the direction, but the timing might just be out. Getting taken out of a trade just too early, type of thing. It's a reality, but timing the market is really an art. And like I said in the beginning of the video, it's something that even I find challenging sometimes. That your conviction and your analysis should see something trading higher or lower, but the market just might not be having it, and it might only be playing out over a larger or longer time frame. That's always possible. So I hope that helps with the question. If it doesn't, please let us know. We'll definitely clarify that. Any other questions, of course, also don't hesitate to let us know.